Okay. So margin fees, CMG's underwriting costs. This is something also very unique. You go with a mortgage lender, it's usually what, 1% of how much you're really applying for, and that can be a much higher number, you know.
Correct. Yeah, they
This is
call them
more of a,
origination fees.
yeah,
Yeah, that's
this is more of a flat number, flat fee,
exactly.
regardless of how big you're applying. So this becomes even more attractive for the person that has a much more valuable property, right? A higher valuable property is only $1,500 to underwrite to unlock the equity in there. That's huge. And
Oh
then we
yeah.
got appraisal. I know I think mine was like 900 something for appraisal. I'm in South Florida. I know in Florida there is a stamp fee or something on lines of credits. I don't know if it applies in other states, but that could be a couple grand additional. So it doesn't
Yeah, I mean
apply
that's
here.
not state specific. I
That's
mean
not safe.
Texas has its own nuances,
Yeah.
Massachusetts has this. This is just
Yeah.
kind of a generic breakdown, yeah.
Right. So in the generics, are we missing anything else here?
No, in the generic fees, we're not missing anything. I mean, there's no daily interest. You don't build an escrow account.
Yeah.
I mean, that's all. That's all there is. In fact, in many instances, comparing apples to apples, it's actually cheaper than a conventional loan in terms
Yeah.
of costs.
Agree. Wholeheartedly because I witnessed it myself. I evaluated. I said, oh, yeah, I'm already, even though I was looking at, I want to say, homes between 7 and 8% was what I was being quoted at different
Yep.
mortgage companies. HELOCs I was looking at were at 9.5, 9.3.
Mm,
Nothing really above under 8. Now I did have a little intro rate to start, but just
yeah.
from looking at the cost to close on my first lien HELOC as opposed to a traditional mortgage, out the gate I'm already ahead. Right. So I'm already
Oh,
ahead of the person that's trying to make extra payments, even though they're at a lesser rate than me. And because I have liquidity when unexpected stuff happens, I don't have to think where to borrow from and how I'm going to pay that back. I've got this automated system here, right? And so coming back to the terms, now that we've covered the general fees, there might be some nuances in here, but that's the general. We covered how to qualify. Coming back to the terms, another thing I forgot is you know what? I'll put it over here because it's more of a function more than it is a term. And this we'll get into the case use of this. So function and case use of the all-in-one. So this is a product that has automation in it, right? You mentioned it earlier, you touched on it, but probably some people missed it. But basically, when your income flows into the checking account that's being provided, that's attached to the line of credit at 11:59
yeah.
p.m. every night, your checking account will go to zero
Mm-hmm.
and it'll get automatically swept into the line of credit.
Yes.
That's every day, right?
Okay.
And so what that does is it essentially before the day is over, right? Let's say you're at an 8.78 rate, right? Let's do some real math on that. I think that'd be super cool for people to kind of understand what I'm getting at here. So say you owe 400,000 on your line of credit and you're at a 8.78% interest rate, and we're going to divide that by 365. So you're looking at $96.21 for that day. For that one
Mm-hmm.
day, you'll pay $96.21, but you won't get charged $96.21 until the due date itself. So,
Correct. Yeah, it's an additive. So
right,
day one plus day two plus day three.
correct.
But
It's not compounded.
correct. So it's not. It doesn't get pulled out that day. So at 11:59, that money moves over, and actually at midnight, your payment is now calculated off of your new balance. So if you owe 300 today, and you made
Right.
10 grand, your balance goes down to 290 at 11:59. At midnight, your payment is calculated off of your balance. So it
Yeah.
actually allows for you to take advantage physically on that day of your reduced balance that day.
Yeah. So let's say using my same number, 400K
Mhm.
minus $10,000 deposit. Now you retimes that again by the 8.78 rate, divide by 365. Now you're at $93.
Correct. So you just saved $3, $2 and
Right. And again, that's just one day. How many more days is that 10,000 staying in the line of credit? So that's $3, $6, $9, $12, $15, 21, right? It just keeps going up and up and up. And that's essentially you're compounding the savings per day for sure.
correct.
And you're offsetting that cost. So you're not ever really paying 8.78%. And when you really look at 8.78% divided by 12, your interest rate is actually 0.73% per month on what
Mhm.
you owe. So then the goal is becoming, okay, how do we reduce 0.73 to 0.5 to 0.3? And so if you're able to reduce 0.73, cut that in half, right? So say you bring it down to 0.36 times 12. So you took a 8.78 and brought it down to 4.39 in the first year compared to your average mortgage rate today, which is in the
Mhm.
6-7% range, right? Even high,
Oh
I
yeah.
say high fives, high six, high sevens, right?
Yeah.
And again, these are people who already locked in their mortgages in 2023, right? And early 2024, where we saw rates go as high as like 7.5, even upwards of 8. I'm over here. We're creating insane amount of speed and velocity on a month-to-month basis. So even though my rate is higher, my cost is different. This is where a lot of people get caught up, right? They get a difficult time seeing that. And so just showing you the math on the day-to-day, deposits coming in, and then when the your expenses, your living expenses eventually come out, what I have noticed having a first lien HELOC that has been to my advantage is when it comes to paying bills that are ACH'd, right? Like it requires a checking and account number to pay the bill, right? I notice it takes 2-3 business days before it actually ever leaves my line of credit. So that's an additional 2-3 more days before the money actually came out of my line. That's even more dollars I'm saving per day, every single day.
Correct.
Right? Like this blew my mind because I was like, that's another like value add where most people, the way they operate today is we make money, it lands in a checking account, and you're separating the money, savings here, investing here, tithing there, giving here,
Mhm.
and then money sits parked in the checking account waiting to pay an expense. Within the all-in-one, I never have to wait. I don't have to have money sitting outside of the checking account because by automation, 11:59 every single night, even if I left $500 and I forgot about it, by midnight it's already in my line of credit. And if I have a bill 4 days from now, I don't have to worry about manually transferring the money back out of my line of credit to the checking account to pay the expense. It's going to automatically draw from the line. And again, it might take a day or two for that bill to actually hit. So I know when it comes to my car insurance, when it comes to when I pay my credit cards, right? My water bill, my sewer, like all electric, right? All of it. My FPL bill, like it takes multiple days for it to actually leave the account. So it'll say pending, but I notice how my line of credit still stays the same. And then I've even like ran the math. I was like, oh yeah, look, it only charged me that amount. That's really cool.
Well, you can get even more tactical on it by actually paying those bills if you're able to on a credit card.
Correct.
And on a credit card, you can even pull it out. Make sure you don't pay that credit card late so you don't accrue that interest. But actually, am I able to share screen? Because I created kind of an even more in-depth version of what you just wrote so people can really get a
Oh
visualization
yeah,
of what.
yeah. Let's do that. So sticking on the all-in-one loan, the function itself, just understand that it has automation. You're able to automate your paychecks. So those of you who are married, right? Husband, wife, and maybe young adult in the house. Husband, wife and parents living with you that get Social Security checks, you guys could be combining all those incomes into one central location, being your all-in-one loan product, let's say in this example, where you could have 2, 3, 4 different incomes going to one place, and then everyone's bills being paid out of that account, right? Over time. That's what I'm doing, right? So like in my own household, I've got myself, I make money, my fiance makes money, my mom makes money. Each of them are sending their paychecks into my line of credit. I myself sending money into the line of credit. And then we just agreed that, okay, for the bills that fiance has when it comes to certain things, my bills and my mom's bills, let's just all have it come out of the HELOC, right? Rather than having money sit in your checking account waiting for that bill to be paid, I could be saving $3, $4, $6, $8, $9 per day just by having money that's already going to leave our economy. I'm saving, so I'm
Exactly.
technically reducing my cost of living, and my savings rate is performing much higher than if I were to have that money in a high yield savings account earning 4 or 5% right now. Insane, right? Because I'm saving a whole dollar where it takes them, you're earning 5% on $1. That's all you're getting. I'm getting a whole dollar in savings for every interest dollar I save, and that's tax free, and it's liquid and available to use again for a later future expense. Again, same stuff. So let me share the screen here.
So this is kind of what you were just doing, but I'm just having it broken down on a quote unquote monthly basis. So this person, let's just say they earn $7,500. I'm going to put it on the second day just so we can see the difference in payment between the two.
Yeah.
So family earns it on the first and they earn $7,500 on the 15th. Again, that's compounding. They go from 96.21 to 94.4. And then additionally, they go down to 92.6. They're saving a boatload of money without paying any bills. This person's just saving $81 this month in interest. That's dinner with your wife. That's dinner with your fiance. That's, taking a night off and going and enjoying yourself with your friends, right? Now, if you paid your bills off, let's say this person right here pays $9,000 in credit card and all the other housing bills. They pay it on the 16th earlier in the month. Their difference, or what they're saving, this is the difference right here, is their saving goes down pretty drastically. But if that same person was to wait to the end of the month to pay their credit card off and all of their other bills, then their savings is going to increase. It's really the time value of money. It's better to hold your money into your account as long as possible until you need to pay it off.
Yeah. And you know
And
what?
that
We could even run, okay, how much money do I need to store in a high yield savings account to earn $74 in 1 month, right? Like when we look at that, like understand like there's a huge value in terms of how we're saving money versus how a majority of other people are saving money, right? And then again, taking a look at the escrow, there's no escrow
no escrow.
in the function of this product. So again, there's dollars that are waiting to be spent on an annual basis that, oh my goodness, could be saving you hundreds of dollars just by having that annual expense sit in the all-in-one for 364 days until the one day out of the year that payment's due.
Yep. And here's a few other
$364 times, say, $2 in savings, that's $728 in savings.
Yeah. That's a boatload of money more than you have in here.
Yeah, that's insane.